G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Allen Wargent Property Buyers. Now, you might notice by omission, if you're watching on the video, that there's no Chris here this week. Sadly, Chris is actually a bit crook. He's got the flu. And not man flu, I mean the real actual thing. So get well soon, Chris. We're going to miss you this week. And always miss having a chat to you on the weekend. So hopefully you get better very quickly and we'll see you next week. So we're just going to do a shortened 2 cents segment this week. So normally what we do is have a bit of a chat at the outset, then we run through the big three property news stories of the week. And then there's time for a bit of a Q&A at the end, which I'll try my best to cover without Chris's help this week. So firstly, let's talk about what's in the news. Well, it was inflation this week. So the long-awaited inflation figures for the September quarter. And as you may well have seen, if you watch the headlines, lots of shock headlines about consumer price inflation higher than expected in the September quarter. So the headline inflation figure was 1.3% in the September quarter. Now, the largest contributor, maybe not that surprisingly, was electricity costs. So you may recall in recent quarters, these have been up and down with government subsidies coming in and out across the various states and territories. Gas prices also rose by 6.7% over the course of 3 months because you get these annual price reviews for gas prices and for households. And there was also some inflation in insurance and also, again, property taxes in the guise of rates, which rose 6.3% over the 3 months. Again, that's the thing that tends to happen at this time of year. You get the annual review after 30 June year end. So if you look at the headline figure, not very good, really, a bit messy. Those electricity costs for households, again, very sort of disrupted by government subsidies, but up 24% over the year. Absolutely brutal and pretty messy. I suppose that's the bad news. I suppose on the upside, there's some of those costs won't be repeated, certainly not to the same degree of inflation. And we often find actually that in the September quarter, we get an upside surprise for inflation. And then in the December quarter, the so-called surprise gets to a large degree reversed. So I wouldn't get too overexcited. You generally do find when you get these market releases, there's an initial reaction. Everybody has a massive panic and quickly jostling for positions, currency traders, bond traders, and then things settle down a bit and we get a bit more of a sober and sanguine view. So I'm going to try to offer that for you today. So the Reserve Bank of Australia obviously tends to focus more so on the core inflation figures. So headline inflation figures are pretty volatile and there's various issues that come and go on a quarterly basis. So the core inflation figures strip out some of that noise. The median market forecast for the September quarter was inflation of 0.8%, but even allowing for the trimming of the core inflation figures, the trimmed mean inflation figure was 1% for the quarter. So quite a lot higher than the median market forecast. So that takes trimmed mean or core inflation back up to 3% over the year. So if you think about the Reserve Bank's target band of 2 to 3%, we've got all the way back to the top of the band. And it hasn't really this time. I mean, we've had various issues internationally periodically, but actually import prices were down again over the June and the September quarters. Oil prices have been fairly subdued, might even be a bit of an oil glut ahead. It's really sort of a homegrown issue for inflation. And I think, I try not to get too political on these podcasts, but I don't think there's would be too controversial to say that really a lot of that inflation is due to a combination of high population growth, which has put pressure on services, it's put pressure on certain parts of the economy, and increasingly we're seeing in the rental market again, asking rents are reaccelerating. And obviously there's no getting away from expensive energy bills. That's been a huge part of the inflation story over the past 12 months. So that's kind of the downside. I think if you look at some of those components of inflation that happened this month, well, yeah, some of those annual price reviews aren't going to be repeated next quarter. Hopefully, we might see inflation insurance calm down a bit because that has been pretty brutal. Again, property taxes in the sort of guise of rates. Again, a big sort of jump this quarter, but hopefully you wouldn't expect to see that repeated in the December quarter. So anyway, zooming out a little bit, I think a week or so ago, November, people were thinking the Reserve Bank would cut interest rates on Melbourne Cup Day, the rate decision that stops the nation, but it won't be so. There's no way the Reserve Bank can cut interest rates with inflation, an inflation quarterly figure at 1.3% or 1% for core inflation. So they will definitely sit on their hands until at least February. In the meantime, unemployment is rising. So we've now got up to a cycle high of 4.5%. So I guess what will happen over November and over the Christmas and New Year break is that the RBA will sit back and wait and see what happens to those labour force figures. So the big picture is the economy have been very reliant upon the non-market sector and a lot of sort of government roles and things like that, healthcare, social assistance. The private sector of the economy hadn't really been creating much employment at all. And now it seems as though the non-market sector is also running out of a bit of steam. So the challenge for Australia to avoid is what's happened in the United Kingdom, where the unemployment rate has been rising quite consistently, and especially in Canada, where the unemployment rate is now above 7%. So they've had high population growth and a slowing economy, and suddenly they've got a glut of unemployed. New Zealand, to a lesser degree, has faced similar challenges as the economy slowed down. So weighing all of that up, well, there certainly won't be any interest rate cuts in November, probably through until February. That'll be the next decision, which is potentially live. Just as a slight aside, the inflation figures are switching across towards a monthly CPI regime, much as a lot of other countries do around the world. So that could be a slight complicating factor. Anyway, let's take my opinion out of it. Let's look at what market pricing has done. So November decision, maybe just a week or so ago, markets were looking at a 70% likelihood of an interest rate cut in November. Well, that's been completely priced out now. Michelle Bullock, in a fireside chat this week, already hinted at a slightly more hawkish stance. And with these inflation figures, no chance of an interest rate cut in November. It's just very small market pricing. The same would apply for December. February becomes a bit more of an each-way bet. We've got a 56% likelihood of an interest rate cut in February. And of course, a lot will depend on what happens to unemployment and to inflation between now and then. So probably a kind of a coin flip really for February. If you go all the way out until June, July, August next year, well, a full cut isn't actually priced in until August 2026. And potentially that could be the end of the rate easing cycle. Now, a lot of stuff can happen between now and then, and market pricing based on index swaps, well, that's what is expected today. But of course, a lot can change. If the unemployment rate rises significantly, then we'll get more cuts. If inflation rears its head again as we run big population growth and that transition to renewables proves more expensive, well, we might not get any easing at all. So it looks like a sort of a long, shallow cycle at the moment. That's what markets are pricing. Just one interest rate cut, maybe June, July or August next year, but not a whole lot else. So anyway, that's the inflation figures. Some of the other bits and pieces of news this week. AFR reported Perth's housing prices nearing a $1 million milestone. So the Perth market is still running hot. Stock for sale listings are still running close to all-time lows. Very, very low listings in Perth. Brisbane listings are also near 20-year lows. So housing prices are generally rising around the country. So if you think about the housing market in that context, of course, nobody wants to see inflation and cost of living pressures, but maybe it's not a bad thing that we don't see an interest rate cut in November. We've already got some very tight parts of the market: Perth, Darwin, Brisbane, Adelaide, Sydney and Melbourne reawakening, even Hobart tightening again. Probably the last thing we need is more interest rate cuts at this stage. That's at a time when the 5% deposit scheme for first home buyers is kicking into gear, which is putting a lot of pressure on the bottom quartile of the market. So yeah, you can read through some of the links that we'll put in the show notes for you. You might have seen in other bits and pieces of news. Now, full disclaimer or full disclosure, I have never, despite working in real estate, I've never actually seen an episode of The Block. So you can take this with a pinch of salt, really, because I don't know what I'm talking about. But I did sort of see in the news feeds, there sort of lands in my inbox from time to time that the properties up for sale on The Block. I've actually got no idea what I'm talking about here. I think the premise of the show is that basically people renovate houses in, is it suburban Melbourne or regional Victoria, maybe Daylesford, and then somebody comes along and buys them at auction. I think that's the premise. Anyway, I've never actually watched it. But in any case, no sales were made, from what I understand, this year. So yes, that might have been partly due to the absence of one of the key bidders, Mr. Portelli. But I think arguably you could say here that this is maybe some of the marginal impact of land taxes in Victoria. I think if you're going to be buying a house for, let's say, $2.5 or $3 million, and then you've got the land value component of that, it could be maybe a 7-figure sum. Or the land tax, you might be paying, if you're buying that as an investment property, what, $30,000 of land tax potentially? Depends where the unimproved land valuation comes in. But that's a lot of money you've got to be forking out. And maybe that's just starting to have an impact. I have previously had investments in Victoria, and the land tax now kicks in effectively for even very cheap properties. So it's just something that's pushing more investors away from Victoria and into other states. Now, that might be good from an affordability perspective, but it might also put some pressure on the rental market. So that'll be an interesting one to watch. So Cotality also reported 1 in 3 property markets around the country now command a 7-figure median house price. So $1 million suburbs have surged 143% over the past 5 years, expanding beyond the traditional prestige areas. Brisbane recorded the largest net change, I quote, in $1 million markets over the year. And despite that, affordability and equality are worsening. So, well, it's probably not so much despite that, it's largely because of that, I would say. But average income holders or average income households would need to spend over 50% of pre-tax earnings to pay a $1 million mortgage. So it's pretty difficult if you're starting at the $1 million price point. And that's why so many first home buyers using the 5% deposit are going into those lower price points, so increasingly for units or townhouses. Now, just a final point before we go to the big 3 property news stories of the week. Interestingly, One Park Lane, a 101-storey mega tower unit block has been approved for Southport on the Gold Coast. Now, let's be clear on that. That's only the approval. Whether or not all of the pre-sales can be made and whether the development gets financed and actually gets built is a whole other question. Maybe they'll need to build in-house because a lot of the developers at the moment, particularly in southeast Queensland, they're hanging on for big projects. There's a little window of opportunity maybe to get residential projects done, but we've got the Olympics in 2032, we've got new venues to be announced or clarified, and then there'll be some major infrastructure projects for the big developers. And it's only going to be big developers who are interested in 100-storey tower blocks. So that having been said, it does sort of suggest the phase of the cycle that we might be in some of those markets. Even the fact that a 100-storey unit block can be put down and then approved suggests that we're starting to see a bit more appetite for risk, more people buying off the plan. New home sales have spiked in September 2025. So yes, we're really struggling to get housing built at the moment, way behind the targets. But if new home sales start to pick up, slightly lower interest rates and maybe just an easing off potentially on some of the construction cost pressures, well, maybe we start to see more of these projects getting out of the ground now. Just a caveat emptor, there was just to put the yang against the yin, there was an article this week in the Sydney Morning Herald about a residential tower that is completely vacant in Parramatta due to defects. So that's always the thing to watch out for. If you're going to sort of run the gauntlet and buy an off-the-plan project, an apartment that hasn't been built yet, you really need to try and cover off the risks to the extent possible. Do your full due diligence on the project, the developer in question, ideally a developer who's been around for more than one cycle and has got a long track record of delivering projects successfully, not one of the newer companies, because that's where there's a higher likelihood, I suppose, of things going wrong. So one final news story before we move on to the big three topics of the week. So just an article I wrote on my blog, actually. Residential land values continued to rise in FY 2025. Commercial land values fell though, as office valuations were written down. Residential land values rose by 7% to 8.3 trillion. So they've actually risen by around 60% over 5 years. Of course, a big chunk of that is population growth. We've got more people in the country, but even setting aside the population growth of 10% or so over that time, it's a big increase in land values. Over FY25, Western Australia, 13% increase in residential land values. In Queensland, 13%. So the total value of residential land in New South Wales rose to 3.2 trillion, a new all-time high, which sounds like a lot, but of course there's a lot of residential land if you think about all the way from Bondi to Bathurst and Dubbo and Wollongong and Newcastle, all of those areas. And of course, I'm sort of reporting that in a week when Nvidia is valued at $5 trillion on the stock market stateside. So the first company in the world to be valued at 5 trillion. But I think the key point here is, yes, there's various parts of the cycle where some states do better than others, but you can see why property has been such a popular long-term investment. I've dragged the chart back in my article there all the way to the early 1990s when the stats are available from 35 years worth of stats. And yes, there's sort of stronger and weaker periods, but overall well-located blocks of land have just been terrific long-term compounding investments. And that's why real estate does become popular for people, because companies can have a life cycle and they can come and go, but residential land is kind of a perpetual asset and you can't destroy it. It just keeps on keeping on. So let's go through the big three news stories of the week. So firstly, from Domain, the 5% deposit scheme kicks off a new cycle. So we saw the fastest housing price growth in 4 years last quarter. Houses led the way, but units are also fighting back. Darwin property prices have absolutely mooned over the past 12 months. Sydney and Melbourne just starting to pick up, really, particularly Melbourne sort of had a slowish start to the cycle. Has the 5% deposit scheme had an impact yet? I mean, it's only really the 30th of October, so it's a bit of a stretch to say that housing prices in Q3 were impacted much by the 5% deposit scheme. I guess you could certainly say that the awareness of this stimulus coming has had a bit of an impact. It's brought more investors in. I think as well, I mean, some of the sort of schemes are available for first-time buyers anyway, just that the property price caps and the income caps were different. So I think it might have sort of brought forward a bit more sort of demand into a very sort of undersupplied market. So yeah, it was also reported in Macro Business, the 5% deposit scheme for first-time buyers has lit a match under housing prices. So the various forecasts around the traps, Lateral Economics forecast that home prices could nationally increase by an additional 3.5% to 6.6% in 2026 and for several years afterwards. But in the segments targeted by first-time buyers, prices would rise by an additional 5.3 to 9.9%. Yeah, I'm not so sure about doing market forecasts to 2 decimal places or to a decimal place, but I think it is definitely true to say we've seen some first-time buyers bringing forward their plans, tapping the bank of mum and dad where necessary. I think as well, some investors are looking opportunistically to maybe arbitrage that opportunity away. If they think the cheaper segment of the market is going to be busy with demand over the next 2 or 3 years, well, they'll probably be looking in the same market. So this is some of the unintended consequences of bringing in a 5% deposit scheme. Also, it goes back to what I was saying at the start, is that the market doesn't really need lower interest rates at the moment. Maybe from a housing supply perspective we do, but in the established market, particularly the cheaper end of the market, there's enough demand there already without hyping things up. So you can read those articles yourself and pick out your favorite capital city or region. The domain and macro business articles will link in the notes. Second story this week, the property tax debacle unfolding in Canberra. So John Kehoe in the Fin Review took a look at this. So Australian Capital Territory was kind of ahead of the curve on this, and their property tax reform was supposed to phase out stamp duty in favour of land tax. But whatever, was it the old John Maynard Keynes quote about this, nothing so permanent as a temporary government programme? Well, unfortunately, the government does tend to become addicted to spending, not just in the ACT, by the way. That's the same in New South Wales and Victoria. And bracket creep has pushed up stamp duty in recent times, in addition to the land taxes. So capital gains have persisted, but the 20-year plan to remove stamp duty, quoting from the article, the plan to remove stamp duty in the ACT has hit a roadblock. In theory, it was the gold standard of tax reform, even if it was going to take longer than ideal to make it feasible. And in 2016, the ACT sort of moved to eliminate stamp duty on insurance policies and so on. But unfortunately, sort of 9 years down the track, stamp duty is not on a path to ever being abolished, despite a price boom fueled by low interest rates and constrained land release. The government has become addicted to collecting stamp duties to fund its ever-increasing spending. It notes the Labour Greens ACT government. So annual rates for homeowners are now more than $4,000 a year, reports the Fin Review, and closer to $10,000 for investment properties paying the extra land tax. So, yeah, it's not really how the idea was solved, was it? The idea was, yes, we'll sort of pay a higher land tax or property rates, but stamp duty would be phased out. But instead what's happened is the prices have gone up. Bracket creep has basically pushed up property prices into new stamp duty brackets. And the government has just found ways to spend that money. So not just an Australian problem, having all these same debates in Europe, in the UK and so on, but also the ACT, the article said, has made the stamp duty situation worse by squeezing the supply of new construction. So the lack of new supply of delivered newly detached homes, it just led to a sort of an ongoing undersupply. It's actually quite wild when you look at a Google Earth map of Australia, a city like Canberra in the ACT, you would just think if there's anywhere that should be able to supply lots of vacant blocks of land for development, it would be there. And yet the constrained nature of the release has just been an ongoing theme for as long as I've been thinking about property in Australia, over 25 plus years. So it never seems to get resolved, and it hasn't. And even though we are building a few more units and apartments. So yeah, so it's just a warning shot, I suppose, for other states and territories thinking of going down the same route, is that yes, you can increase land taxes, but if stamp duty is not being phased out either, because governments get addicted to spending, it's not great for homeowners, and for investors, it's far from ideal. So last story before we do Q&A, your listener questions. The new housing hack to beat the bank of mum and dad. This was also in Domain, actually. More Australians are buying with siblings to beat affordability challenges. Research last year by ING found that nearly half of Aussies would consider buying with someone who's not a spouse or partner to buy a home. NAB's lending executive said 2024 saw a 33% increase in family and friends buying homes together. The highest growth was in Victoria at 47%. I suppose that might mirror demographic trends in Victoria, more Indian migration, for example. I suppose on the plus side, you could avoid some CGT, but you do need to, I think, plan your exit strategy. And I think more than anything, you have to have a pretty healthy relationship to begin with, because obviously life plans change, life gets in the way, and a lot of things start out with best of intentions, and then situations change, people partner up, or or separate or whatever happens in life, or people decide to move to a new city and they want to use their borrowing capacity somewhere else. So I think if you're sort of looking over a 5-year time horizon, and then you can have maybe a plan to sell at the end of that period, I think that's probably an okay way to go. I just think you need to be quite clear about how you're going to work through the valuation, who gets what happens if somebody wants to sell earlier or move on to somewhere else. So again, I've sort of seen a lot of these things over the years, and they can work well, and it's a way to get on the housing ladder by buying with a spouse or a sibling. Buying with a sibling or another family member, but it can be fraud with some risks as well. Okay, we've probably just got time to wrap up. We won't waffle on too long without Chris here. Listener Q&A. Hi guys, this is a question from S. Hi guys, just a general comment on your pod. Should we cut immigration? One of the points you left out, and it's absolutely fundamental to buying property. This was on our deep dive show on immigration the other day. The immigration, whether it's direct or student immigration, for example, many international students study engineering. I'm a maintenance planner, which has always been a well-paid job. Now, for every vacancy, you have 100 applicants, and businesses can afford to pay a lot less. So what should be a 120k job is now 80k, and us long-term Aussies are fighting for the same job. So even if you get your borrowing capacity, it's going to be lower. You're competing for houses in a market that can just get out of reach. And this is happening across the board. Immigration maybe needs to be paused to allow everyone and the assets in the system to get back into equilibrium. Cheers, great show, by the way. I think it's a pretty interesting thing, actually, because for many years there was sort of a big debate among economists in Australia as to whether high rates of immigration were dampening wages growth. And there was sort of debates, well, you know, if you look at Victoria, that's got bigger immigration and wages growth has been the same there as in states with lower immigration. And then we did get a pandemic pause on immigration. Of course, what happened was we had shortages across hospitality, tourism. We didn't have backpackers or international students around, and rates of pay shot up. And I think it's quite clear that high rates of immigration clearly have an impact on wage price growth. Certainly been a challenge in parts of Europe. In my experience over the decades is that some cities have a lot of graduates competing for fewer roles, and therefore they get into a lot of student debt, and then suddenly what they were expecting at the end of the process just doesn't have the same availability in terms of roles and pay and benefits and career progression. So look, it's definitely an impact. So it's definitely having a big impact. I think there was definitely going to be a snapback from the immigration pause through COVID, and that's exacerbated a lot of the challenges and pressures on infrastructure. But it does seem to me that Australia is a bit of an outlier now. If you look at our population growth, if we're running population growth at nearer 2%, or we have been, versus a lot of other countries where it's under 1%. Now, yes, things are probably going to normalize over the next year or two, but we do seem to be overshooting migration targets, and it's what starts to create tensions, traffic problems, rental property crushes, and also, as you said, it has a knock-on impact to the availability of skilled roles for pay and all of that. So I think, yes, the government itself has said we need to lower immigration, but it's happening slower than they had planned, and it looks like we're overshooting. And so again, I suppose international students, it's become a huge growth cog of the Australian economy and a lot of other countries too. And on the plus side, it's kind of an export, and it sort of brings in new skills and so on. But it also creates pressure for existing graduates. I know from personal experience when I worked in financial services in Sydney, there were relatively few opportunities for homegrown Aussies, and a lot of times it was easier just to import people from United Kingdom or South Africa or anywhere else where people already had qualifications down pat, and they could just parachute into a senior analyst or a management role. And fewer opportunities for people who've been through the Aussie system, and at times that can get out of whack. I think the mining boom did create some skill shortages, but now we've gone the other way. I think it's definitely something that has changed since the 1980s. I remember the progressive side of politics was generally a bit more sort of against high rates of immigration because it did depress pay. These days, sort of the left side of politics seems more in favour of big rates of immigration, but maybe the polling demographics have changed and it's more of a middle class voter that sort of leans towards Labour voting these days. So yeah, look, I think it's that everyone has their own sort of views on it, and obviously as an immigrant myself, I've been experienced some of these things firsthand, and heard some of the feedback from people and so on. And Britain and parts of Europe are going through the same challenges. So is Canada, New Zealand, and it's creating a lot of tensions, that's for sure. So thanks for the comment, Des, and appreciate you listening in. So I think I've talked for long enough today. So hopefully Christoph will be getting back on deck for next week. I know he's been pretty quick actually this week, poor guy. So send in your questions. There's a couple of other questions we didn't get time to cover today, but I guess the big news story this week was the inflation figures. That's the biggest thing in the news. Interest rates will be on hold on Melbourne Cup Day and all the way through until February 2026. And what happens between now and then to inflation, and particularly the unemployment rate, will determine whether we get further interest rate cuts. But market pricing says nothing now really until August 2026, when we might get a full interest rate cut priced in, but not much more. So if you're in the property market, don't overstretch, don't expect interest rates to fall much further from here. And even some people I've noticed have been fixing mortgage rates. First time in a while we've been able to say that, because if you can get a rate at around 5% locked in, then that might not be a bad thing. Although it's generally not the way people do things in Australia. So I'll leave it there for this week. Send in your questions. If you want to join us on the Rask community chat, community.rask.com.au. Got any comments or questions for Chris or I, there's a link in the notes there as well. So get well soon, Chris, and thanks everyone for tuning in. We'll see you next week. Cheers.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.